When we were talking about oil prices, we spoke about the fact that if you tracked volatility with respect to prices, you could see some relation between them. There is some correlation between the two. But it's not just prices and volatility. I mentioned earlier that there are blends. So there is Brent for us, for the local context, regional market, Brent, Upper Murban, Dubai Oman Fateh, Iranian heavy, and Saudi light. And they are also correlated to each other. So when you look at correlations at a higher level, you can see that oil blends are correlated to each other. And this, from the looks of it, it appears that the correlations are actually quite close. But once again, there's a different perspective. So this is one perspective. This is a second perspective. Here's a third. This is correlations between fuel oil and crude oil, which you would think or assume are related commodities. And what do you see? If you look at the picture as a whole, in one figure, you'll get a figure of X%. But if you take a different lens and you investigate the trend, you can actually see that correlations also change and move. They go up and they come down. They go up and come down. So they're not static. So if you're modeling it, if you're using it as a signal, it would be advisable to evaluate that assumption, right? And that's the whole point of algorithmic trading, that you identify signals, you understand that these signals shift, and you go out and take action that could translate in terms of trade, buy or sell, based on the nature and intent, based on the information that signal provides. Does that make sense? Just like trailing volatility goes up and down, similarly correlations across asset classes and trends and patterns also go up and down. So at a high level, when we look at data, when we do the calculations on our own, we'd say that if I had a portfolio, and let's say that portfolio is represented by this color, and I compared the performance of that portfolio to bonds, to currencies, to commodities, to the New York Stock Exchange, or to NASDAQ, I can see that 2010 was a great year for commodities. But 2008 and 9 was a terrible year for commodities. And so was 16. But this is a very one-dimensional, singular point of view for both correlation and return. What is the point of sharing this data? हम क्या दिखाने की कोशिश करें? What's the takeaway? नहीं, लेकिन आप ऐसा अगर इस केस में देखें तो it's not stable ना. आपने बना तो लिया मॉडल, तैयार भी कर लिया, एलोकेट भी कर दिया उसकी बेसिस के ऊपर, बट राइट एट द पॉइंट व्हेन यू थिंक यू गोइंग टू बेनिफिट फ्रॉम इट, राइट, इट विल डिसअपीयर. जैसे हम यहाँ पे देख रहे हैं, एंड यू विल सी दिस अगेन एंड अगेन. जैसे आपने वॉलेटिलिटी को ट्रेल किया ना, आपने क्या किया बेसिकली? अगर आप इस पॉइंट को देखें, व्हाट डज दिस पॉइंट रिप्रेजेंट? इट लुक्स एट द लास्ट 20 days of prices, and using that as a reference, it calculates the standard deviation or vol for that series. And then it sort of adds one more day and then calculates it again and then repeats it again and again and again, right? So जैसे आप
सर हम वेट्स चेंज करते रहेंगे, जैसे ही हमारा डाटा चेंज होता रहेगा, हम वेट्स जिन से असेट्स में जो वेट्स साइन किए हैं वो वेट्स भी चेंज करते रहेंगे. इफ वी आर अज्यूमिंग के वीक फॉर्म एफिशिएंट नहीं है मार्केट्स,
नहीं, हम एफिशिएंसी हम अज्यूम ही नहीं कर रहे. अगर हम एल्गोरिथम्स की बात करें या सिग्नल्स की बात करें तो वी बेसिकली देखें. सो मैं आपसे जो मेन पॉइंट आई एम ट्राइंग टू एम्फसाइज इज, वेयर डू आई गो बैक? एक है आपके पास रिस्क, ठीक है. How do we represent this in our model so far in the framework, the presentation that we're using? We're saying this is represented by standard deviation, ठीक है. And this we use a short form for it, that's vol, which is a short form for volatility. तो एक एलिमेंट ये, एक एलिमेंट हमारे पास रिटर्न है, ये एक एलिमेंट हमारे पास कोरिलेशन है. तीन आ गया आपके पास. अब the point that we're trying to make is कि when you look at this data set as a whole, it gives you one number, and that number is 2.47% standard deviation on a daily basis, or 2.47% volatility on a daily basis, right? This is one. And this also corresponds to some x correlation with some asset class. But the point we're trying to make is that neither volatility, you can see this, right? It goes up and it comes down, goes up, comes down, goes down, goes up, comes down, goes up, comes down. You see this, right? It's not stable. It's not static. It's not in that same range. And the same thing holds true for correlations. They also go up, come down, go up, come down, go up, come down. So the static view that we've been taught, that we sort of work with, that we use in our thinking, in our analysis, that standard deviation, a given standard deviation on looking back period, a given correlation using a look back period are static. They're not. They go up and down, which basically means they'll also go up and down in the future. So if you build a portfolio allocation model simply using correlations or volatility or standard deviation or returns, the performance of that future model in the future is going to be a question mark. And one way we address that and we fight that is we try and build theses, models, signals, where we assume that these signals are going to change on a minute by minute basis, and our algo will react accordingly based on what the signal indicates. Does that make sense? Does everybody follow the point that we just made? So let me give you another example. This is a visual history of USD Treasury yield curves from 1978 to 2014. This is the point where rates were at their peak. You're talking about rates in the 20 to 25% range for the US economy in this time frame, right? These are the stagflation. These are the years where, Paul Volcker's attempt to control inflation were sort of, and you also had sort of a fallout from the petrochemical blockade, right? So there are lots of factors at that specific point in time. So what held true here doesn't hold true here, does it? The models change, right? हम assume करते हैं कि correlation constant है and correlation stable है. It is not. We're not talking about systematic risk. We're simply saying, मैं आपको बहुत simple example देता हूँ. All right. Are you following what's happening with GameStop and Robinhood? If you take a step back, what you're really saying is कि ये hedge funds हैं. And in hedge funds के आपके पास there are two separate classes of assets. They have their longs, positions that they felt were likely to go up, and they had their shorts, positions that were likely to go down. Okay? And essentially what has happened is that because of a range of factors and drivers, their short positions went up because the market felt that they were overshot, right? So when these positions went up, what did the funds have to do? They had to sell their longs, and as they sold their longs, what happened to the longs? The longs came down, right? So अगर आप historical data देखते हो और आप कहते हैं कि for example, you had security X and Y in your hedge fund portfolio. Historically speaking, let's say there was no correlation between them. Zero correlation between them, right? And that gave you a fair bit of diversification potential. But at this specific point in time now, right, over the last 10, 15, 20 days, X and Y have gone down together. So there is correlation. And why is that correlation exist? Because they were both positioned in a hedge funds portfolio on the long side, which the hedge funds had to liquidate to make sure that they could meet their margins and control and cover their losses on their short positions. Do you understand what just happened? Nowhere in the historical model was this predicted or forecasted. Your model does not cater to it. So if you build the model using correlations, it won't hold. I understand the theory says this. I understand the textbook says this. I understand everything that we've studied says this, right? But from a trading point of view, From an algorithm point of view, the algorithm doesn't see that. The algorithm says there are instances where correlations break down. There are instances where vol break down. There are instances where the relationship between risk and return breaks down. And when those instances happen, what should I do? What's the command that the algo has? I should conserve capital. And to the algo, what does conserving capital mean? I should cut my losses. Reduce my losses. When we speak about financial technology, innovation and disruption, everything that we've studied so far is open to question. And the example that we're possibly trying to go through is we're simply saying what we're trying to look for, there should be 3-4 things that should be very, very clear to you. One is, what does an algo do? An algo looks for a trading signal. Is this clear? Does everybody understand this? An algorithm, a trading algorithm, looks for a trading signal. That's the life. That's the reason for being, the reason of existence for a trading algorithm. Looks for a trading signal. But they're not a unique set of signals. Signals vary, change. They're not set thresholds. Thresholds vary and change. They vary and change. Why? Because markets move and change. What worked here in 1978 and 79 did not work in 92 and 93, and what worked in 92 and 93 did not work in 13 and 14, and what worked in 13 and 14 is not going to work in 18, 19, 20 or 21. नहीं, that's a fair point. That's your point is a fair point. हम जो चीज़ emphasize करना चाह रहे हैं is what we're saying is कि there are other signals, जैसे आपने कहा, there are other signals beyond correlation, risk and return and volatility and other drivers and factors. And what you want to do is you actually want to do a few things. You want to actually write algorithms that identify new signals and new relationships. Because they're getting introduced in the market, right? जैसे अभी आपके साथ GameStop, Robinhood, hedge fund case में क्या हुआ है? You said something new has happened in the market, which basically means that we have to reevaluate what we used to do in the past and replace it by something else. Point of the matter, what we want to sort of get to, जो हमारा objective है, हमारा objective ये है कि अगर मैं एक algorithm बनाने जा रहा हूँ, historically आपने alpha beta तो पढ़ा हुआ है ना, you've studied alpha and beta. So what is the definition of beta? Beta is essentially a representation of the part of the return of a security that can be attributed to the market, right? That's beta. So alpha क्या है? Minus the beta return, right? So हम ये कह रहे हैं कि अगर फर्स्ट करें मेरे पास एक security that gives me a 20% return, and let's say the return that's attributed to the market is, let's say 5%, then इसका alpha कितना होगा? 15% होगा.
Yes.
Right? So we're saying I have a security where the actual return is 20%. The return that's attributed to the change in market is 5%. The return which is attributed to non-market factors, right, which are security specific factors, is 15%, and that's my alpha. Allocation model बना रहा हूँ. If I'm building something which would essentially represent creation of a portfolio in such a fashion that I get an above average return, and I'm sort of mixing it around with beta and alpha, and I'm saying there is possibly a trading signal between beta and alpha, right? So despite the fact that we have issues with correlation, despite the fact that we have issues with covariances and volatility and returns, despite the fact that we have issues with markets, we're saying there is possibly a signal in there. Can we trace that? Okay. And what we want to do is we want to say, okay, if I look at just returns for all the securities in my security universe, if I look at risk for all the securities in my security universe, and I sort of say, okay, I'm going to build a model using beta and alpha, right, which is basically an extension of CAPM, how would that model work? Remember, intent क्या है हमारा? Intent is we want to build a model, we want to identify a signal, and हम framework क्या इस्तेमाल करें? Immersive, iterative, experimentation, right? We're trying to build a model, we're trying to build an algorithm to get a sense of how does algorithmic trading works. So this is your security universe, right? In the security universe, you have a bond index, you have a currency index, and you have a commodity index. Then you've got NICE and NASDAQ, also indexes. And then you have a list of tech stocks. and some non-tech stocks. So Merck, MetLife, Tupperware, and Nike are non-tech stocks. Everything else, so GT is non-tech, Apollo is non-tech, Potassium is non-tech, but you got Google, Yahoo, Apple, Microsoft, right? Then you got three currencies. Then you have, bonds. Then you have commodities. So the yellow line gives you a sense of return, and the blue bar gives you a sense of risk. So if I ask you to allocate a portfolio, if I ask you to create a set of positions that would maximize return using historical data, क्या करेंगे आप? कहाँ से स्टार्ट करेंगे? तो आपने शार्प रेशियो इस्तेमाल कर लिया, ओके। अच्छा, अब ये जो प्रेजेंटेशन है, ये जो आपके पास ग्राफ नज़र आ रहा है, दिस इज़ अ लिटिल डिफिकल्ट टू रीड और ट्रांसलेट. देखने में तो बहुत आसान है, बट व्हेन इट कम्स टू एलोकेशन यू नीड अ डिफरेंट रिप्रेजेंटेशन. When it comes to allocation, you switch perspective, you switch the lens. Now what do? It's the same information presented in a different way. So return versus volatility for that same security universe. अब इसमें आप क्या पिक करेंगे? What would be your top picks and why are you picking that?
The highest return per unit of risk.
So this is return and this is risk. So highest return per unit of risk Apple का है, और उसके बाद फिर किसको पिक करेंगे? So that's Tupperware. Then Potassium. Potash is a Canadian company that does fertilizer. It's the Fauji fertilizer of Canada. Then GT, right? Because that's Goodyear tires. And इस साइड पे क्या है? So ये आपने क्या बनाया? What have you just made? So this is what? This is your algorithm that's picking up these positions. यही मॉडल है ना आपका? आपकी thesis क्या बनी? Thesis is Sharpe ratio and allocation optimization. And how did you narrow it down to Sharpe ratio? Because you've studied portfolio optimization, because you've done the CFA, because you've done some exposure to treasury. Correct? So आपका challenge क्या है? Challenge is you want to build a portfolio model. You want to sort of make sure that your allocation strategy works. You want to sort of define, pick up an optimization metric that your algo focuses on. That's the performance metric that the algo works with. And then you want to review it and you want to repeat it. यहाँ पे मैंने क्या किया? यहाँ पे I've said कि alpha with respect to NICE, alpha with respect to NASDAQ. So the blue line and the orange line. These are the two lines you want to track. What did you pick? You picked Apple. So ये Apple यहाँ पर आ गया. You picked Google, तो Google भी यहाँ पर आ गया. और क्या पिक किया था आपने? शुगर पिक की थी. शुगर कहाँ है यहाँ पे? शुगर. एंड देन फिर आपने क्या पिक? आपने टपरवेयर पिक किया था, तो टपरवेयर यहाँ पर आ गया. नाइकी आपने पिक क्यों नहीं किया? If you go back to your model, where is Nike? Nike is here. इधर आ रहा है. So risk and return के perspective से Nike doesn't sort of fit in. But the reason why it's showing up here on the alpha point, is maybe there is some other factor. And what would that factor be? That factor would most likely be correlation and its overall impact on the portfolio volatility. We ran some numbers, right? We said if we took maximum beta and if we use that, so if you sort of created a portfolio that maximized beta for the portfolio, minimize beta, maximize alpha, minimize alpha, maximize beta and alpha, minimize beta and maximize alpha, which one would you pick? So if these were, this is 1, 2, 3, 4, 5, 6 strategies, right? These are 6 approaches that you're using to create an allocation model for your trading algorithm. If these are 6 strategies, which strategy would you pick and recommend? So ये जो आपके पास blue line है, this one, right? This is your holding period return. ये जो orange bar है, this is your beta. And ये जो line draw हुई हुई है, this is your alpha. So do you see something? When you maximize alpha, you also maximize return. We have created a simple model, right? But we are not done, because this is your starting point. This was your thesis. अभी आपने काम start किया है. So जब हम experimentation की बात करते हैं तो ये जो आपने the plot that you done in the prior slide, the one that we just highlighted here, this plot, what is this? This is your experiment. You actually created these 6 strategies, you ran the model on those 6 strategies, and you created a performance metric or a score for these 6 strategies that sort of said, okay, of these, the one that have done the best, that have outperformed everybody else, both have max alpha as a common denominator. So that tells us, okay, maximum alpha is a possible signal. Now, max alpha is not something that you observe directly from the market. You only observe prices. So max alpha you have to calculate. Somewhere in your engine there is a piece of code that calculates value of alpha for all securities in your securities universe. And there's another piece of code that takes all of those values and says, okay, if I build a portfolio that would maximize alpha of that portfolio, what would be the composition of that portfolio, right? This is where the iteration piece comes from, right? So for us, the iteration piece comes from where? Remember we showed you this diagram? This was what? This was the visual history of US Treasury data, and we built a surface here. So हमने surface बनाया था, and we built that surface to get a sense of where rates had been and where rates were heading as far as US rates were concerned. Then we repeated this for the Pakistani market. So this is the same surface, but this surface has been done for the Pakistani bond market. How is this different? You can clearly see that the rate structure is very, very different compared to US treasuries, right? You can see that, right? यहाँ पे shape बिल्कुल मुख्तलिफ है, यहाँ पे shape बिल्कुल मुख्तलिफ है. So then the question that comes to my mind, जी पूछिए सवाल, comment. जो आप normal shape देखते हैं ना curve का, वो आप ये देखते हैं. अगर आप side से देखेंगे ना इसको, तो आपको ये line नजर आएगी. So ये line essentially, if you think in terms of, this is your upward sloping line. इसको अगर आप plot करेंगे ना, in your normal standard 2-dimensional one, this is that line. ठीक है. और पाकिस्तान के केस में अगर आप देखें तो you can clearly see कि the shape has been, यहाँ पे भी upward sloping है, ये भी upward sloping है, ये भी upward sloping है, ये भी upward sloping. ये अगर आप point देखें, this is where it has really steepened up, right? और ये point देखें तो यहाँ पे it's become flat. So now the question is not so much with respect to this yield curve. The question is कि the inspiration, जो हमने iteration की बात की, the inspiration for taking surfaces from yield curves and applying them to holding period return. So now this is your same holding period return data, right? What do you see here? यहाँ पे आपको क्या नजर आ रहा है? अच्छा, इसमें ये देखें, ये जो blue trends हैं, thresholds हैं, ये are -100 to 0%. So this is negative returns. Orange is positive, and ये जो grey हैं, this is significant. हम HPR की बात करें, तो आपको grey कितने नजर आए? Nike grey in 2009, उसके बाद grey नहीं हुआ. Apple grey also in 2009, फिर grey नहीं हुआ. But Apple's been sort of unique in that sense that it has sort of done reasonably well throughout the period of a study, which is the last 16 years. Apollo has been a disaster. ऊपर जाता नहीं चाहता, ऊपर जाता नहीं चाहता, right? Or who has been, JC Penney has been a total disaster. It did very well till 2011, and then it just went south. और कौन है who does well? Microsoft had a bad patch यहाँ पर in 10 and 11, but since then it's done well. Do you see that? 3 elements है ना हमारे पास. Immersive, iterative, experimentation. So immersion comes from where? Because you have background, you have exposure to the field, you understand what the theories are, you understand where models come from. Iterative means you've sort of been playing around, you've been experimenting, right? And so immersive, iterative, experimentation means that you've tried multiple things to get to a point where you actually have a thesis. What is your thesis? So the trading model is alpha is cyclical. It'll go up and down. It reverts to the mean. So that basically means कि जब alpha ऊपर जाएगा तो फिर नीचे भी आएगा, जब नीचे जाएगा तो वापस ऊपर जाएगा, फिर नीचे आएगा फिर ऊपर जाएगा, फिर नीचे आएगा फिर ऊपर जाएगा, फिर नीचे आएगा फिर ऊपर जाएगा, right? It won't be this rhythmatic, it won't be this clear, this crystal, but it'll follow the same trend. So if you are here, what's the expectation? You're going to go down. If you're down, if you're here, what's the expectation? You're going to go up. So इसके गिर्द trading rule क्या बनेगा? So when alpha is down by a certain amount for a certain period of time, right? When alpha has been negative for a certain threshold, and this threshold would vary by each stock, which is something you have to calculate. You'll have to calculate what the benchmark return would be that would define that threshold. That threshold is the algorithm. If you cross that threshold, if you're beneath that threshold, you buy. If you're above that threshold, you sell. आपने start किया था risk and return से and Sharpe ratio से, और आप पहुंचे कहाँ? आप पहुंचे cyclical alpha के ऊपर. यही किया ना हमने भी, और तो कुछ नहीं किया, राइट? और इसमें कितनी देर लगी टोटल? विद 15 मिनट की ब्रेक हमने से सवा घंटे में, 1.5 घंटे में कर लिया. सो इन 90 minutes we covered, we sort of came up with a new algorithm. Does that make sense? But we were able to do that because we had all of this data. Somebody had done the groundwork for us. So, you can do this groundwork in, let's say, an Excel spreadsheet if you have the data and the time and the capacity, and you can very easily do it for about 100 securities. But what happens if you have 1,000 possible securities across the world, across markets, and you have to do this in real time? फिर क्या करोगे? तो हाथ से तो नहीं कर सकते ना. And हमने अभी सिर्फ एक सिग्नल आइडेंटिफाई किया है, which is cyclical alpha. What if across these 1,000 securities you have at least 100 trading signals that you're tracking? And each of those trading signals generates either a buy or a sell order. Can you do this by hand? Can you do this manually? It's not just that you need the code, you also need data, right? You need a real-time feed that's giving you a sense of what's happening to the market. It's not just data feed. You also need news feeds. You also need other indicators. Then you need the ability to parse them and see whether this is a positive factor or this is a negative factor, right? तो हमने यहाँ पे तो इसको आधे 1.5 घंटे में cover कर लिया, right? But the history of this, the history of getting to this point in time, to this insight, is also interesting. We'll talk about the backtest later. So when I said immersive iterative experimentation, I said you have to come from the field. You must have some exposure to the field. You can't just sort of walk in and say, I'm going to build a new algorithm. You have to have the capacity and the time and the patience to try different things. You must also have the capital and the willingness to be open to change, right? So in my case, this actually came out of the 3rd edition of a book that I wrote, which is Portfolio Optimization Models in Excel. And the book came out because I did risk for almost 20 years. I did back office systems for 30 years. I've been teaching for 25 years. I do value opinions, fair value opinions on portfolios for 16 years. I've been doing model building for 30 years. And I've been playing with Lotus 123 Excel since I was 14 years old. All of this is immersive iterative experimentation. So my question to you is this easy or is this difficult? If somebody comes to you and says, Kiji, I've got a great trading algorithm and I'm going to make money with it, what's going to be your normal reaction? आप क्या कहेंगे उनसे? नहीं तो एक सवाल और है ना, वो सवाल ये है कि जो मैंने चीज़ छोड़ दी थी आपके लिए, right? This was sort of like the trap. The trap is just because it worked for the data does not mean it's going to work now in the future. जी बिल्कुल. But I think the bigger factor is जो हमने पहले बात की थी, अगर आपको याद हो जो हम शुरू में, right in the beginning when we spoke about correlations and volatility, we said correlations are not stable. Volatility is not stable. It goes up and down. Correlations are also not stable. They also go up and down, right? So just because this relationship holds, right, between what we call cyclical alpha for tech stocks, and again, specific to the universe of security that we've tried out. जब आप इसको backtest करेंगे, you test it out for a broader security. You test it out for period of study जिसका data set was not included in your training set. Actually put some money on it and see whether the model returns cash, whether it returns a profit, or whether it loses money, whether the model makes money or doesn't make money, right? These are all factors that come into a backtest. नहीं देखो, इसमें जो मेन सवाल है ना, मेन सवाल ये है कि डेटा पे तो मॉडल चल जाता है, लेकिन मार्केट में मॉडल चलता है नहीं चलता, दैट कैन ओनली बी आंसर्ड व्हेन यू पुट मनी ऑन द मॉडल. व्हेन यू पुट मनी ऑन द मॉडल, that is when you say कि अच्छा अब we have confidence कि ये चलेगा या नहीं चलेगा, whether this will work or not work. I think if I were to summarize, right, what I want to summarize is, if I look at the points that we've made, पहला point हमने क्या make किया कि there is a reason for being for an algorithm, right? And what is that reason for being? That reason for being is return on capital. That's the objective, while preserving and conserving capital. ठीक है. फिर हमने कहा कि the objective of the algorithm is to identify a trading signal. So there is a lot of data that's coming in from multiple sources, and the algo looks at all of this, parses it, translates it, processes it, ingests it, does calculations on it, and decides whether there is a signal or there is no signal. If there's a signal, it'll say buy or sell. So you want to sort of identify what these signals are. In our case, when we did this for equities, the signal is specific to a market, and the signal is specific to a data set. So just because a signal exists in one market in one data set does not mean that it will exist in the same market on a different data set, or it will exist in a different market on the same data set, right? So there is some exploration here. And then finally, the real test of an algo is when you put dollars on it, and the algo returns more dollars than you've put into it, right? This is the objective of a backtest. And then you sort of roll it out. So your confidence in an algorithm, your confidence in a strategy, your confidence in a model and approach increases once that model starts to earn on your behalf. That's the process. So अब इसके लिए जो एक key part है, and again we still summarizing, इसके लिए जो एक key part है, वो key part ये है कि to do this well, you need to have some background and exposure in the field. And for us, we say that three things. So immersion, you must have a combination of education, experience, knowledge, wisdom, and exposure, and also some failures in that field to understand कि क्या चलता है क्या नहीं चलता. Right? Just for example, when you were talking to Essen earlier, I said कि correlations are not stable, volatility is not stable, it changes. How did I find that out? मैंने भी वही किताबें पढ़ी थी, आपने पढ़ी थी. So 30 years, 40 years ago when I started studying portfolio management, I read more or less the same material, the same book, the same theory. Because if you think in terms of CAPM hasn't changed, it's still the same. There are some variations, some adjustments to it, but essential, the core proof, the core theory, the core principles have been the same since it was first written out. उसमें तो फर्क नहीं आया. मैंने भी पढ़ा, आपने भी पढ़ा. फर्क क्या आया? फर्क क्या है कि I've been sort of playing with it for the last 15-20 years, and there are things that I've noticed and identified that have sort of become part of my thinking. So वो आपकी immersion हो गई. फिर क्या हुआ? फिर आपने देखा iterative, right? So iterative में क्या हुआ? You've done something multiple times in different ways, in different shapes and form. And for me, I think the key jump was taking the surface and plotting that surface for holding period return for my data set, which is where I saw okay, there is a trend there. And that trend then basically translated into what I called alpha cyclicality. अच्छा, अब alpha cyclicality discover कैसे हुई? How did I find out that alpha is cyclical? We found out that alpha is cyclical when we did a few things. One, we said, given this data set and given this data, right, what would give us maximum return? And more importantly, in terms of performance, to which factor would we attribute that performance, right? So this analysis came from the experimentation piece. We ran through maybe 10-15 different strategies. We tried them out. We looked at the numbers, we compared the numbers, we tried not just the strategies, we also tried different performance metrics. And वो तमाम distill होके, so if you think in terms of actual time, from the point that we started playing with the data set to the point that we got to the algo, the actual time was about 4 years. 4 साल लगे to get to this point in time. And this is what I mean, right? This is painful. It takes time. It's not that easy. When somebody comes to you and says, I can build an algorithm that will trade and make money on the market, unless and until they've got all of these factors together, there is a chance that there is still more work that needs to be done. It can be done. I'm not saying it cannot be done. I'm simply saying there is a lot of hard work involved. And that's my objective, right? So if you remember, पहले दिन मैंने क्या कहा था आपसे? I'm going to take a very cynical approach to everything in and around the fintech space. I often hear people telling me that building models and building algorithms, especially trading algorithms, is easy. So building models and algorithms is easy, I agree. Making money from those algorithms and making money from those models is not easy. That requires a lot of hard work and patience. तो अब आप में से कोई समराइज करे कि आपके समझ में क्या आया जो मैंने आज चीज़ कवर की इन द लास्ट आई थिंक 2 hours, 2.5 hours, right? What is, when you go back home or when somebody asks you कि आज की क्लास में आपने क्या पढ़ा, तो आपने क्या पढ़ा, क्या सीखा आपने? What's the key takeaway? What's the one line lesson that you've taken away from this entire exercise? जब मैंने पहली दफ़ा पोर्टफोलियो मैनेजमेंट पढ़ाना स्टार्ट किया था, which was I think about 5 years ago, so I remember this really beautiful, gorgeous book that I'd read when I was taking the portfolio management exam 1995, 1996 mein. And it was, I've forgotten what the name was. This was also prescribed for the CFA level 2 or level 3 के exam में भी prescribed थी किताब, हमारे इसमें भी prescribed थी. And the authors were Magnin and Tuttle. So Tutle, and the other one was Magnin. So we used to call it Magnin and Tuttle. तो जब मुझे पहली दफ़ा किसी ने कहा कि आप पोर्टफोलियो मैनेजमेंट का कोर्स पढ़ा दें, मैंने कहा ठीक है. एंड आई थॉट कि आई जस्ट गो एंड पिक अप मैग्नेट एंड टटल एंड आई यूज इट एंड मैं उसी को इस्तेमाल करूँगा. सो व्हेन आई pick that book up, and this is after spending 20-25 years working in the field, when I picked that book up and I went through it, I said, यार उस वक्त तो बहुत अच्छी किताब लगी थी मुझे, लेकिन now after spending 25 years in the market, I can't teach this because इसमें ऐसी कोई चीज़ नहीं है that I can apply at work at my own desk. So if I'm teaching the subject, then I want to make sure that if I'm teaching it to my students, they understand what works in the markets that I worked in and what doesn't work in those markets. Now, a lot of things that we've spoken about aaj may not necessarily work in Pakistan because the data set that we're working with is basically a US data set. So I think the other big question is कि अगर आप यही model लें and you apply this model to Pakistani equities, will it work or not work? We don't know. We'll actually have to try it out and see कि चलेगा या नहीं चलेगा. जो हमने tools इस्तेमाल किए हैं, alpha and beta, right? We've used them a little differently, but essentially if I'd never studied CAPM, then I would have never gotten to alpha and beta. And while I haven't used, अगर आप typically traditionally thinking देखें portfolio theory के अंदर, तो उसमें हम focus करते हैं market sensitivity के ऊपर, right? हम beta के ऊपर focus करते हैं. हम alpha को record करते हैं, alpha को report भी करते हैं, alpha के साथ काम भी करते हैं, लेकिन हम alpha को treat बहुत कम करते हैं. तो अगर in that context आप सोचें, unless and until you learned or studied or appreciated CAPM, unless and until you realize all the issues and challenges with CAPM, you wouldn't get to alpha cyclicality. Alright, so with that we'll stop. Thank you very much for your time and your patience. I will see you guys next week.